Hey guys, my name is Brian, also known as Brian Makes Benjamins here on YouTube as well. I've been starting up this Clock Out Capital with my friend John, and I'm going to go over the strategy that works best for my investing strategy. And that's the wheel strategy. And it's very simple. It's very quick and easy to learn, in my opinion. And it's the easiest way where I was able to generate a lot of income every week, every month, every year. So let's jump to my desktop, and I have a slideshow for you guys to show you. So the wheel strategy, and this is the simplest way I could teach it. So this is exactly what I'm going to go through. And a little bit of background of myself. Like, I've amassed over $1.3 million already in net worth. I've been a nurse. I still work as a nurse since 2012, and my portfolio is mostly stocks, crypto, and real estate. And stocks is really like my bread and butter. That's what got me everything. I was able to pay for my wedding, my honeymoon, all with that. And I've also noticed like a lot of people just don't understand the stock market. So that's what I wanted to get into. So of course, who is this for? This is for all of you guys that are trying to figure out the stock market, how to make more money in it. So this is going to be really tailored to income-oriented investors. So like long-term stockholders, risk-averse individuals that want to make a systematic approach and also want to make a little bit more money than just waiting and holding for the long term, like the 30 years. This is like the one where you kind of want to expedite it a little bit. And you also got to remember, there's no get-rich-quick scheme. This isn't it. This is using selling of options to generate more income while gaining growth, appreciation, and all of that. And then, so let's just go over into basics. What is the stock market? The stock market is a marketplace where buyers and sellers trade shares of publicly held companies. It allows investors to buy and sell ownership stakes in those companies, known as stocks or shares. It is a crucial part of the economy, facilitating capital raising for businesses and investment opportunities for individuals. And then, what is the wheel strategy? This is what we're here for, guys. So we're going to go over that it's a popular trading strategy. Let me move this down a little bit like that so you could see. Popular trading strategy that involves selling cash secured puts and covered calls on stocks. It's a method used to generate income from options, premiums, while potentially acquiring stocks at a discount and selling them at a profit. Sounds like a win-win, right? So when to use the wheel, let's move this up here now. So why we use this? Income generation, that's why I use it. By selling options, you collect premiums that can provide a steady stream of income. Stock acquisition at a discount. Selling cash secured puts allows you to potentially buy stocks at a lower price. So say stock A is currently trading at 100, doing a cash secured put, you put it for like 90, so that's technically a discount because it's currently trading at 100, and there's potential that if there's a pullback, you're able to buy it at that 90, and then most likely it'll go up back to that 100 in the future. And then you could also profit from stock appreciation. Selling covered calls allows you to profit from the appreciation of those stocks that you own. And then the flexibility, the strategy can be adjusted based on market conditions and your personal preferences. So you can make money on a down market, you can make money on an upward market, you can make money on a sideways market. And here are the risks of the wheel. Assignment risk. If the stock price moves against you, you may be assigned the stock or have the stock called away from you. So that's on both sides. The market risk, the value of the stocks you own can decline, leading to potential losses. And the opportunity cost. By selling covered calls, you could cap your potential upside if the stock price increases significantly if you don't do a second part to the strategy called rolling. And we could go into that in another video. I just want to go over the wheel strategy by itself. So let's go over some vocab for us over here. Let's move this up here like that so you could see. Strike price, this is the price at which option to buy or sell a stock will be exercised. The expiration date is huge. The date at which the option will be exercised or be considered worthless. Call, option play that gives you the right but not the obligation to buy the stock at a specific price at that expiration date. A put is an option play that gives you the right but not the obligation to sell a stock at a specific price by a specific time, the expiration date. ATM at the money, ITM in the money, OTM out of the money, and premium is the current market price of the option contract, income received for writing said contracts. And then here's a little bit more continued covered call. This is what you really need to know. When you have 100 shares and use these 100 shares of stock as collateral for the option play. So you need the 100 shares for this. Cash secured put is when you have enough cash to buy or secure 100 shares for that option play. So you need collateral. It's either 100 shares for collateral or 100 shares worth of cash for collateral to get started. And then the rules. Simple. Only use this on stocks, companies that you would want in your portfolio. You need 100 shares of that company or enough cash to buy 100 shares. You need at least the level 1 options enabled, which is the bottom. We only sell options, and you need to understand the basics of the vocabulary here. And then what do you need to start? Obviously, we just talked about that level 1 options. You don't need more than this, and I don't really recommend going past this if this is strictly what you want to do. Anything else could put you at more risk to your plays. Do not activate margin. That means borrowing, because if you don't have proper risk mitigation, risk management, it could wreck you. So don't do that. And level 1 is the easiest way to apply for options. To apply, you just need to answer the risk assessments of your brokerage. They ask you like your occupation, how much you make. You have to put your net worth over 100K or they might not accept you. And just say you have options experience, like 2+ years. And you should be approved for all of these if you just follow this as is. And then the wheel strategy. The goal is to collect income, also known as premium, involves selling cash secured puts, purchasing stock when or if the put is assigned, and then selling covered calls against the stock right after. Both the put and call are sold and out of the money. The wheel works best in bullish markets, and in my opinion, works best by owning the stock outright, and doing covered calls is more advantageous into collecting more income. But you could always get into that by starting on the cash secured put side first. So this is usually my starting point. This is selling cash secured puts. This is when you have enough cash to buy 100 shares, you pick a strike price below the current price of the stock, and then the bid ask. Multiply this by 100 to figure out how much premium you're going to get. It's usually going to be the bid. The goal is to pick a strike price that you're okay with buying the underlying stock at. If it doesn't hit your strike price by the time of your expiration date, you could just keep rinsing and repeating the same cash over and over again while collecting premiums. If it does hit your strike price, you will be assigned those 100 shares. That means you'll have to buy it at that strike price that you chose, and then you would move on to selling covered calls. And then selling covered calls, you now own the 100 shares of the company. Now it's time to make money on it. Now you choose a price above it. So you sell, call, choose a price above your cost basis. So if you bought those shares at 100, I would choose a strike price above 100. In doing so, you take advantage of appreciation if the stock goes up, as well as taking on the premium each week. So choosing a strike price should be at a price you're willing to sell your stocks at. You could either use delta or choose certain numbers. I usually choose a delta of less than 30% if you're beginning, or like $4 away. That usually is around the 30% delta or not. If the price of the stock goes past your strike price, you'll be forced to sell your 100 shares at your chosen strike price, and then you would move on to selling cash secured puts again. And that is only at the expiration date. Like 4 p.m. at the expiration date, you'll know if you're going to have to buy or sell those stocks if you get assigned. And again, how do you choose a stock? I say it has to be a stock that you want in your portfolio, stable and well-known companies, blue chip stocks. Look for those established ones. And volatility and liquidity. Just because a premium is high does not make the stock a good stock for this strategy. The more volatile a stock, the higher premium you're going to get. But I wouldn't necessarily always do that. Like I personally use Tesla, Nvidia, all those pretty volatile, but very, very well-known stocks, and they're not going anywhere. If you choose other stocks that are just up and coming, you might have really big premiums, really big chance of a high ROI, but those stocks could also fluctuate way too much where your cost basis will have you wrecked in the long term. So again, don't chase premium. And then you could also do this with dividend paying stocks, where I always say this is like triple dipping or double dipping. If you're able to do covered calls, you get the appreciation, you get the premium, and you could also get dividends as well if you own the stock doing covered calls. And then pretty much this personal interest and understanding. And then let's do an example here. So let's open up Nvidia, right? And Nvidia. Sorry, I keep saying it wrong to a lot of people. That's how I've always said Nvidia. So let's do a little example right here. So since I'm recording on February 12th, let's do this for 9 days away. So again, you need 100 shares or 100 shares worth of cash. So the starting place is always for me a cash secured put. So you need around $13,000 to start this, just to have 100 shares, like 130 right here, right? So I'll be on the sell put side, and then what I would choose is something with a delta of 30. So let's go that $4 away. And the delta is what you look for, 31%. You can do that, or 126. That'll probably be a little below, or we could do that. Perfect. So let's choose the $4 away, 126, and the delta is 28. So that's 28%. So in doing so right here, you could look right here and you would get paid $184 for the week for selling this put. So you could either do weekly or go out as far as you want. I usually do weeklies, bi-weeklies, or monthlies. So you could either get $184 right now, or if you do a month from now, like 30 days from now, you could look for another 30% over here. I mean, 30%. You get paid $470. So let's just do that. So a month from now, March 14th, we're gonna sell. So always sell. You put and do 122 is your strike price. Your delta is 30, and you're gonna get paid $470 to write this contract. And that's gonna automatically go into your buying power. Say when it hits March 14th at 4 p.m. that the stock price stayed above 122, you're always going to keep the premium. You're always going to keep it. And now on Monday, following this March 14th, all $12,200 will show up right back in your buying power, plus the 470. And then you could do another cash secured put the following week, month, or whatever you want to do. And you can keep doing this over and over again. And then say on March 14th, going the opposite way, it did go to like 121. So as long as it goes below 122, so it could be 121 and 99 cents, you will have to buy 100 shares of Nvidia at 122. So your buying power of 12,200 would now turn into 100 shares. You're always going to keep the premium. And then on that following Monday, now you'd be on the covered call side. And that's when you would choose like a strike price above 122. And then you just keep doing this over and over and collecting as much premium as you possibly can throughout the years, the months, whatever you have this stock for. And this is, to me, the best way to generate as much income as possible. I'm going to go way more into detail on this strategy on this channel as well. I just wanted to show you guys a quick little breakdown of it. This is what I personally do that brought one of my portfolios from $35,000 all the way up to $80,000 in 1 year. And that's what I'm That's the portfolio that I always show on my own personal YouTube, and I'll also show it here as well. So let me know what you guys think. Let me know if you guys learned anything. Check out the free Discord in the links down below, and I will see you guys very soon. And don't forget to like, comment, and subscribe. I really look forward to hearing from you guys, and let's get rich together. Peace.